Welcome to the Salty Investors episode number 70. It is Thursday, March 14th. How are you, Tim?
Oh, I'm getting there. How about yourself?
Getting there. Well, that doesn't sound good. I'm already there, mate. I'm already
Nice.
there. No, I wish. But anyway, let's get into the salt for this week. I will go first. So as you're no doubt aware, Tim, every couple of years the states start bitching and whinging about they're not getting their fair share of the GST. New South Wales Premier Chris Minns has come out and said it should be allocated on a per capita basis. Well, he would say that, wouldn't he? Because he's the Premier of New South Wales, the most populous state in Australia. But I have another idea, Tim. How about competitive federalism, as the architects of the Constitution intended? It might actually force some fiscal rectitude on state governments. They wouldn't be able to rely on being bailed out when they had a bad year. It might stop them incinerating money on projects that they never build, like they do down in the People's Republic of Victoria. And they might have to do some long-term planning, almost as if they were a business. But we know that's all just wishful thinking. That would make politicians more accountable for the money they waste, which is not in their interest.
Yeah, it's a bit disappointing. Like, I think Queensland and WA, they've got slashes, so, or, only small increases. So, yeah, Victoria did really well out of it. And I think South Australia.
Of course.
So,
yeah.
I don't know what they've done recently, to add to the GDP of the nation or anything. Not sure.
I don't know what they ever do. Yeah, but I mean, I just don't understand why we have to, it's just a socialist redistribution system. I mean, how about you run your state in a way that makes it attractive for people to go there and set up businesses and whatever else, and be responsible. I mean, it just enables useless states like Victoria to screw their economy up and get bailed out to some extent. It's absurd.
Yeah, well, the productive class again is in trouble, and it's going to people who don't produce much, and then you do that over a long period of time. What's the result? Yeah. I don't know. You tell me. So I don't know. Doesn't seem to be too long-term thinking here. So at some point it'll have to change.
Yeah. What do you got for us this week, Tim?
The government axes 500 tariffs on household items, but that's only 14% of all tariffs. Everyday items like toothbrushes, tools, fridges, dishwashers and clothing now have no tariff. For example, the tariff on toothbrushes raises $22,000 a year in revenue, but it costs society multiple times this in compliance and government's costs. The reason we kept them for so long is the theoretical bargaining chip with free trade agreements, but everyone knew they had little or no value. So, good work removing them, but why didn't they do it decades ago? And what about the other protection tariffs we've got running now? Why can't they be removed?
Why not? Why not indeed? Yeah. Get rid of them all. Get
Cost of
rid
living.
Of all of them. Yeah. All right. Let's move on to some macro stuff. As is the case in the US, every month we got a CPI report. Headline CPI. Look at that, Tim. What happened? What happened to the story? That it was just, this was plummeting back to the target range, 2%. We're going to be at 2%. I thought we were going to be there now. That's what we were being told. But look at that. It's going sideways. That's headline CPI. Core is still just under 4. But wait for it. This is super core. This is, core services X housing. That's super core. Now, remember when we went into when you got the high inflation, everyone was saying, well, look, housing is lagged. Like that portion of it's lagged. So it's not reflecting the actual cost of housing at the time.
Yep.
Course, super core takes out housing and it's going up. So that there at 6.5%, that is the last 3 months annualized. Remember, this works. We always have to point this out, that when people are going, a while back saying 3-month annualized, look, it's just plummeting. It's falling off a cliff. We're going to be at 2%. Oh, so let's use that 3-month annualized that you were doing back then to justify that. Oh, it says 6.5% annualized. Where's the Fed again? I think the Fed's not even at that rate. So again, the narrative, we've been fairly good on this. We've said, look, it's not going to go down a straight line. It's going to be higher for longer. You're not going to get your rate cuts yet. and this just more of the same. I think it's just, you know, and
Well,
I did see there's a spate of stories out after this day that came out. Economists and analysts are grappling with what if 3% is the
no.
is normal now, you know,
Yeah.
like, oh yeah, what if? Who would have thunk it? Who made, it's like,
Uh,
yeah. I mean, it just, you only, if you read some of the history on this stuff, it's very
mm,
hard to get it back down. Like, it doesn't just go up, come straight back down again.
yeah.
It gets embedded to some extent.
But the market's still looking through it. So
Yep,
we're
that's
still
right.
looking through it pretty heavy. And, at some point here, if it, what point does the market go, well, like it's hard to look through it because it just keeps on, staying where
Yeah,
it is. That's probably only correction territory. I'm not talking doom and gloom, but a pullback's
yeah,
possible here. A 10% pullback. I can't see that off the cards. If we don't get one in the next couple of months and, a cut in the next
yeah,
couple of months, I think the market would be thinking, well, how many are we going to get this year? Are we going to get two? Is it possible to even fit in two? At some point we get to middle of the year. So,
yep, yep,
yeah.
yes. So on that question, Mr. Doom and Gloom himself, Jeremy Grantham. I say that with all due respect because I love what he writes.
Mhm.
So he's just put out a latest missive for GMO. He says the US is really enjoying itself if you go by stock prices. A Schiller P of 34, 1st of March, is in the top 1% of history. Total profits as a percent of almost anything are at near record levels. Remember, if margins and multiples are both at record levels at the same time, it really is double counting and double jeopardy. For waiting somewhere in the future is another July 1982 or March 2009 with simultaneous record low multiples and badly depressed margins. But for those who must own US stocks, most institutions, even when they're generally overpriced, there's a reasonable choice of relatively attractive investments, relative, that is, to the broad US market. So if you go and read his whole missive, he talks about other investments,
Okay.
emerging markets.
Hmm.
He also made the case that this bubble, remember, he was calling this the everything bubble a couple of
Mm.
years ago, right? It did burst in 2022, and then he says further in this missive that it was sort of bailed out by the AI boom,
Mm.
like that
Mm.
prevented it. I don't know. That's maybe it's a little bit too neat
Uh,
for me.
I know.
The other thing about a PE Schiller of 34, you have to remember that you can't really compare it to say 2001 because Trump cut taxes in 2017. I think by the time he got them through. So margins, I mean, you can't really compare the margins because
Okay.
it's, you know what I mean? Like margins would be higher because tax rates
Yes.
are
Okay.
lower. A
Yep.
little, it's not, it's, but it's still expensive.
Hmm.
And yeah, margins and multiples at highs is you don't usually get bull markets from here, if
No.
you know what I mean. It's unless we're
What's
going
a
off
Schiller
into the
going to go up to the
stratosphere.
40s or something? Yeah. So
Yeah, well, um,
it's cyclically adjusted, isn't it? 10-year. Is it the
yeah.
Schiller? So,
10-year trailing. Yeah,
hmm
10-year trailing. Yep. So yeah. So that's that's Mr. Grantham. He's always a good read. So go and read that. It's this will not be in the show notes because we don't do show notes. So go and find it yourself, you lazy pricks. It's on GMO's
yep.
website.
Hmm.
All right. Yeah. I think that's it. Now you want to plug something here, Tim?
Yeah.
What do you
Yeah.
got?
Me and the boys have created a little Chrome extension that lets you see your stock quotes in Chrome. So if you go search for Financial Toolbar and the Chrome extension store, you can pick up this for free. You can get 3 stock quotes in your Chrome store. Just giving you prices all the time, so you can watch your stocks fall while you're reading your email or searching the web or on Facebook. You
Hmm.
can probably you shouldn't be watching them that closely, but if you, I'm using it at the moment to see if I'm trying to, my buy prices are coming up. Like you've seen these huge swings. There's a bit of
Yeah.
vol going on in some of these stocks. And I'm using it to think, oh, if I hit one of my targets here, I want to get in and log onto my account and grab a few.
Yeah.
Um, so that's what, as a long-term holder, I'm still sort of using it. And you can put up other things like Bitcoin and gold and exchange rates and all that sort of stuff. So I don't normally do a plug of my own thing. I don't sort of, but it's a free product. So I just thought, people liked it or wanted it. Yeah, give it a go.
There you go. It's free. Get into it. Stock quotes. All right. This week's stock, it's an old favorite from the .com era.
Yeah.
Cisco.
Yep, Cisco. So Cisco mainly sells high-end IT software, high-end IT hardware, sorry. In the year 2000, it passed the market cap of Microsoft, becoming the most valuable company in the world. Performance since then hasn't been that great. It's currently within 10% of its 52-week low, so I thought I'd have a quick look. Let's look at the fundamentals. Shares outstanding are decreasing nicely. Employee headcount is increasing, but well under revenue growth. On a PE basis, it hasn't been cheaper in the last 6 years. On a price to free cash flow basis, it's pretty average. Over the last 6 years, the return on invested capital has been in the low to mid 20s and stable, so fairly good. Margins are still consistent and good. Growth has been poor, but a little bit better on the EPS basis. A decent dividend, but a large payout ratio, good interest coverage. If we flip over to the balance sheet and cash flow, we see that it has a net debt of negative 17 billion, which is great. Operational cash flow and free cash flow isn't consistent, and the current numbers are under the 2019 levels, which shows a bit of a concern. Overall, not too bad, but the growth is terrible. And looking forward, I can't see it improving. They missed the cloud transition. And yes, they have products today for the cloud, but Amazon, Google, and Microsoft are so far ahead. And I can't see we're going back to hardware solutions over cloud. As I can't look ahead 5 to 10 years, it's hard for me to buy, especially with a headwind, even with these low valuations. I'm changing my tune, so I'm not buying junk anymore. Currently at a price to free cash flow of 14, growth might be 4% over the next 4 years. So if I was interested in buying, I'd need a price to free cash flow of 8. So I need a 40% drop from today. It seems hard, especially when the current price has dropped so much recently. In 2000, it looked unstoppable, but predicting the future is hard as the free market takes no prisoners.
Yeah. Well, we talked about this. Did we talk about this last week about, that we shifted from hardware to software,
Yes.
and there's better margins and better returns in software than hardware.
Yep.
You still need hardware, but that's not where the growth is it?
No. I can't see people building, racks of stuff anymore. They can just load up Amazon and, chuck all their stuff in the cloud.
Yeah.
It's a lot easier for a business. So,
but does Cisco then design systems for, the cloud has to be hosted somewhere, data centers, whatever. Do they build hardware for those, right?
Yeah. Yep. So that's why, it's still making sales and, still quite a good business, but how much incremental leverage can you do on a business like that?
And data centers have turned out not to be great investments. They're really tough, and that's why people like Amazon doing it in house, right, rather than outsource it. Next DC here in Australia, big data center builder. They've built, I don't know, what are they? They built one in just about every capital city. I think they've built maybe 3 in Melbourne and Sydney. Huge amounts of capital investment. The returns aren't great. The returns, they're profitable, they make money, but the returns haven't been excellent, haven't been great on those. Jim Chanos was short a lot of these data centers a while back. He was saying, just uneconomic. Not that they're bankrupt, but just low return businesses. People spent too much money on them, too much capital investment, not the greatest returns.
Yeah, and when you've got hardware that scales so much, like every couple of years it, doubles in its speed and its capacity, you're not exactly buying lots of hardware, all the time. They can just slow down that cycle if they need to a little bit. So I don't know. It just seems a bit of even though it looks cheap, it's just where are you getting the growth from? Just look at those growth numbers, like a 10-year revenue growth, 1.8%. Like,
So what they've just been buying back stock, have they?
Yeah, that's how they've been juicing the numbers. Like
Yeah.
they do a few acquisitions here and there, but when you've
Yeah.
got a huge payout ratio like that, plus you're buying back stock, you haven't got anything left over. What there's no cash left over to be buying, decent quality businesses that might be, 10, 20 baggers to add to the portfolio. You're sort of
Yeah.
stuck just collecting a dividend here, and it's only 3%. Like it's not like
No.
yeah, it's just one of these traps that I would have loved, a couple of years ago. But now I'm looking at the growth and trying to look ahead. Yeah, I can't really see it. It might change. Something might happen, and we might all go back to, in-house storage, and all the routers and everything need to be on premises. But that's just not going to happen in reality.
No.
Yeah.
No. No. Yeah. So they've had their day, this mob, and yeah, you just like, okay, it's a big company, good returns on capital, decent margins. Where's the growth? Where is
Yep.
it? Can't see it. So unless you have a market crash and it gets to a PE of 5 or
Yeah.
8 or something, and yeah, you'd buy it. You'd just buy it for the rebound. But other than that, why would you? It's just,
Yep.
and you'd probably find more attractive things anyway.
That's right.
Yep. All right. There you go, people. A blast from the past. Cisco Systems. Check it out, and check out Tim's what do you call it?
A Chrome
Stock
extension.
Chrome
Yep.
extension stock ticker. All
Yep.
right. And we will see you next time.